Hello Sector Watchers, welcome to the show. This is the 119th episode of Sector Spotlight for Tuesday the 15th of March, recording it on Monday the 14th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands as usual. You can find my contact details on the screen in case you would like to ask any questions or get in touch otherwise. For today we have a very full show. Of course, we were going to talk about the rotations as we saw them in asset classes and sectors last week. I'll try to do that relatively quickly. Then I want to address a point that I see floating around in the various media on technical analysis, and that's the pretty obvious positive divergence that we're currently seeing in the SPX and the S&P 500. I'm going to give you my take on that. And then I'd like to take a look at the rotation in equal weight sectors and small cap sectors and break that down into the offensive, defensive and sensitive groups and see if we can come to a view on the general market based on those rotations, which sectors to prefer, which sectors to avoid, and what the impact will be on the market as a whole. Let's get started with Sector Spotlight. Last week's rotations in asset classes. Daily RRG on the right, weekly RRG on the left-hand side, and we can continue to see the enormous strength of both tails that represent commodities, DJP and GSG. Here on the daily, they had a little bit of a dip, but they already started to pick up again on the RS ratio scale, and here on the weekly RRG, they continue to power further into the leading quadrant. Let me quickly bring you the charts for GSG and DJP. Here is GNX, that's the underlying index for GSG. And you can see that we had a big rally and we're coming down now for the first time since quite some time, which is not worrisome because we're dropping back to that breakout level. There's plenty of room for this market to breathe, to drop back to old resistance levels that can now be expected to act as support, and the same goes in the relative strength line. If you look at the longer term picture, then we see that long-term breakout here, and despite the rally that we had over the last 2 years, if you look at this chart, it looks as if there is much more in store, and we all know what's going on in the world right now and the impact that that's having on the general commodity complex. DJP shows a similar picture. Rapid rise, almost vertical, and now dropping off its highs. If you look at the longer term picture, this is completely acceptable. There's no problem at all. Market can drop back to that old breakout level without hurting the enormously strong relative uptrend that's already in play. And the only thing that you may see is that these tails on the RRG are rotating a little bit downward, maybe hitting the weakening quadrant, but as long as they stay far to the right, they remain in a strong uptrend. What I'm going to do is I'm going to tick off these boxes on those RRGs and redraw the RRG to get, sorry, my fault, redraw that picture to see the other rotations a little bit better. I'm going to do the same here, tick them off and then fit, and the update. DJP, GSG, fit, and here you go. And now you can see what has been happening. You see the erratic picture here. Main message from an asset allocation point of view is that the risk asset really is the stock market, and to a lesser degree real estate. On the daily, SPY is inside the lagging quadrant. On the weekly, it's still on the move, inside weakening, but towards lagging. V&Q is following it on the weekly chart, and you can see that we had a hiccup in real estate over the last few weeks, but it's starting to roll over again. The only asset class that's really strong right now is the US dollar. You see it pushing further into leading on the daily and as well as on the weekly RRG, and there is general strength for fixed income related asset classes. But be careful. This is all on a relative basis. So government bonds, high yields, corporate bonds, they're stronger than stocks. But if we look at the individual charts, they don't look that good. If we have a quick look at VBINX, that's the benchmark that we're using, we're now seeing that this series of lower highs and lower lows is confirmed once again with the drop below its previous lows last week. If you look at the chart for government bonds, that's the aggregate ETF that covers the whole US yield curve, all maturities, and you see that we had another drop below that previous low. Relative strength is improving, so this is typically the case where government bonds are dropping less fast than stocks. That's why they're showing up inside the leading quadrant. Doesn't make them an interesting investment from an absolute point of view. Relatively, yes. Absolute point of view, maybe not so good. Same story for the 10-year treasuries, which dropped and confirmed their downtrend, dropping below the previous low. And here is the yield, so that's the reverse, and you see that we're on the way to that 3% target that we pegged a couple of weeks ago based on that big inverted head and shoulders and the head and shoulders reversal here on the price chart. Going to leave it at this for the asset classes. We're going to take a look at the S&P later on when we talk about divergence a little bit more in depth. When we switch to the sectors, we see the following images when we start looking at RRGs. Right hand side the daily, left hand side the weekly. Still, the tail of energy extremely strong, both on the daily and the weekly. The fact that it's rolling over slightly on both images actually. You see here that on the daily XLE tail is rolling over a little bit, and we see a similar image here on the weekly. Suggests that there might be a little bit of a pause upcoming in the energy sector. Nevertheless, it is the strongest sector in the group, and it will a lot of time will be needed before this turns all the way back down to weakening and even back into lagging. So for the time being, energy definitely remains the sector to watch. We're going to do the same here as I did with the asset classes. Just tick off the tail for energy so we can get a better handle, a better view on the rotations for the other sectors. I'm going to do the same here for the daily. And then you can see how last week was basically driven by, well, sensitive and defensive. Utilities and healthcare, definitely defensive rotations, but primarily also the negative rotation continuing for technology and for consumer discretionary. I think that remains the main theme for the time being, that those really big sectors inside the S&P 500, tech and discretionary, continue to rotate negatively, and it's happening on the daily RRG here, and it's happening on the weekly RRG here as well. As I explained multiple times before, when you have a lot of market capitalization, a lot of weight in heading in one area, we do need more sectors, more market cap to offset the market cap of those sectors moving into the leading quadrant or the other direction, because it is a zero-sum game. When you add up all these vectors, you will come out at zero. So that's the reason why you see this high correlation or high concentration of tails inside leading, while there's only two and communication services inside the lagging quadrant. Similar story here on the daily RRG. These sectors continue to gain in terms of relative strength. It is relative, it's not in price terms, it's in relative terms. And you see weak financials, but they've been picking up a little bit, and you see that communication services here is already starting to roll over and head back down to the lagging quadrant. And we're going to see the same here on the weekly, where communication services is sort of disconnected from the rest, way down to the left, really strong underperformer. We could say even offsets the energy tail that is disconnected to the right. Communication services is disconnected to the left. That's the image that we have right now. I'd argue that we're still in a defensive mode, that there is still a lot of risk in the stock market as such, and that the preference based on these RRGs, based on these daily and weekly rotations, goes to the more defensive sectors. But we're going to take a look a little bit more in depth later on when we're going to start watching the equal weight and the small cap rotations. I quickly want to go over a few of the individual charts that are worth looking at the moment. That's materials. And let me highlight that tail here. You can see it's a short tail, but it's starting to pick up and travel in the right direction. And what catches my eye here, not necessarily the price chart, although it is not breaking support levels, it's moving sideways, which is a good thing when the market is doing that. But the relative strength is coming out of these doldrums, out of these ranges, heading over resistance, and that's a good sign. So that's probably going to create some follow-up for the materials sector. The industrial sector, kind of similar. Again, not from a price perspective. It's holding up very well above its support level, above the lower boundary of that range that we've seen for about a year right now. But what I really like is the slow rotation back up of relative strength, and that's pushing both RRG lines above 100 and the tail into the leading quadrant. So that's a sector definitely to keep an eye on. And then on the weaker side, once again, here is technology. You see that it's now really starting to break below support levels offered by these three former lows. But what's more important, you see that the relative strength line has now really dropped below its former breakout level and start to head lower, pushing the RRG lines way below 100 and the tail into the lagging quadrant. And the consumer discretionary sector is doing that already for a couple of weeks. Discretionary is kind of leading tech. You look at the tails and you see that discretionary is already further inside the lagging quadrant. Here also a clear confirmation, series of lower highs and lower lows in the price for XLY. But again, here it's now clearly breaking below that support level that we had marked for quite a time already, and it's pushing both RRG lines lower. So tech and discretionary definitely to avoid. And a couple of sectors that might be worth looking at, definitely from a relative point of view, materials and industrials. I owe you a view on the S&P 500. We skipped it when we were talking about asset classes, and the reason for that is that I want to address the phenomena of divergence. A lot of articles, a lot of people talking about divergence all the time. It's a subject that comes back time and time again in technical analysis. But right now, people are talking about the positive divergence in the S&P 500. Now, divergence, I'm pretty sure you all know what that means. Very quickly, it's when price and an indicator are not following the same rhythm, the same series of highs and lows. A good example here is where price sets a higher high, and in the indicator, and in this case it's the RSI that's very widely used to spot divergences, the indicator sets a lower high. Now, always the indicator is leading. So in this case, it's a negative divergence, and that suggests that there is some weakness coming. We had it again here very recently. By the way, this is the weekly chart. You can do it on all time frames. You see again that the S&P put in a new high, and it wasn't confirmed by the highs in the RSI. They made a lower high, putting in another negative divergence. Here's an example on the MACD. That's also a widely used indicator, also very often used to spot divergences. And you can see a similar behavior where the MACD was already putting in lower highs, where the price was still pushing to new highs. Now, when you do that on the chart of the S&P 500 on a daily scale, we can see similar behavior, similar phenomena. We had, in the last year, we had a few occurrences where we had a negative divergence. Example is here in July, then again around September. And the big one here was in November, December, where there was a very strong divergence between price and the RSI. And now we see a similar phenomenon where the RSI is putting in higher lows and the price is still putting in lower lows. Now that's an interesting phenomena and something that we need to address. The problem, or maybe it's my problem, is that most people, or a lot of people, think or interpret divergence as a signal in itself. So as soon as they see some divergence, then it's a signal to do something. It's like it's an immediate trigger, and I don't agree with that. I think divergence is something like an orange or a red flag. It alerts us to a situation that is not normal. There is divergence. Price is diverging from the indicator, or better, the indicator is diverging from price, and that gives us a little bit of a heads up. And in case of this positive divergence, it's a sort of a heads up that, hey, the decline as we've seen it is slowing down. And there is a likelihood of a pause in the decline or a reversal. But the simple fact that there is a divergence present is not enough. Or at least in my book, it's not enough. When I see the divergence, I mean, you can't miss it. It's definitely there. But I need to see in the price chart something positive. And that something positive can be a lot of things. It can be a sort of a reversal pattern. It can be a break of support or resistance. Anything that confirms the direction of the divergence. So in the case that we have right now, where we have a positive divergence building up between the S&P and the RSI, I would like to see something positive. And something positive on this chart will be hard, but I think would be a break above 430 when we get out of that declining channel as it is building up right now. And you can see that this is already today. This is Monday's price action already in there, and you can see that again we had a new low. We had this low here is, you know, the lowest low of the last 5 days. So you know, when we break below 415 this week, if that happens, then I guarantee you that this divergence here will break. The RSI will break below its rising support level, basically negating the divergence. And very often when that happens, when a divergence breaks, you get an acceleration lower. Because don't forget that a low RSI is a sign of weakness. It's not a sign of strength, it's a sign of weakness. That RSI is low because prices have been dropping and prices are low. So please be aware when you look at divergences, it's a good warning signal. It's a very interesting signal. It gives us a heads up, but always look for something else, for some sort of confirmation in the price chart. Completion of a double top, double bottom, breaking of support, and again, bringing it back to the here and now. I think I would like to see a break at least above 425, but preferably above 430, taking the S&P out of that declining channel as we've seen it building. And I have a very hard time believing that that will happen anytime soon. So that's my take on the divergence as you see it building up right now. It could lead to a little bit of hiccup, but we can rally to 430 with that divergence intact and still be in a downtrend. So what's the value of that divergence in this type of constellation, is this type of structure? We're still in a downtrend. Buying in a downtrend is like buying falling knives and bouncing cats and all that kind of stuff. You've got to be very, very careful with that. I think the structure as the price is right now, rallies are selling opportunities. We are in a downtrend and we need a lot more to reverse that. Now for this last segment, I have split my screen 3 ways. And what I'm going to do is I'm going to talk you through the breakdown. You know that we started using the breakdown of offensive, defensive, and sensitive sectors. And I've got 3 screens. One shows you large cap, mid cap, and small cap rotation. So we're going to look at the rotations for the various market segments broken down by offensive, defensive, sensitive. Now on the left hand side you see the RRG for the offensive large cap sectors. This one are the offensive equal weight sectors, and this one are the offensive sectors for the small cap sectors. Offensive small cap sectors. Now what you see here is of course discretionary in all 3 is deep inside the lagging quadrant. That is the leading sector going downward when you talk about offense. Now when we look at the other tails, then especially in large cap and in small caps predominantly, you see that all these tails are rolling over again. They went through a little bit of a hiccup, a good rotation, but that seems to be coming to an end from a small cap perspective, and they're rolling over. When you look at equal weight, materials is standing out. That's actually doing pretty good, and it's on the back of the improvement of the materials sector. Remember that we looked at the materials chart earlier in the show. It doesn't seem to work for the small cap, but it does seem to work for the large cap and the equal weight segments. Nevertheless, it's a split universe with a clear negative for the discretionary sector, which, as you know, is a very heavy weight from a large cap perspective. Even in equal weight, it's clearly down, and also from a small cap perspective, it's clearly down. Now, if you switch to the defensive sectors, and that's the theme that I've been touting for quite a while, is that I think that the biggest message is coming from the strength in defensive sectors. I think that's the story of the market right now, where the defensive sectors are really the ones that people are looking for. Definitely when you look at the large cap universe, healthcare, utilities, staples going through a pause, but definitely utilities and healthcare are picking up. If we look at the equal weight, then you can see a similar pattern with healthcare is still improving here. It needs a little bit more work. Staples here also are going through a pause, but they are the highest reading on the RS ratio scale, which is a good thing. And then on the small cap, you see the same thing here. The staples sector is already inside the weakening quadrant. Maybe it will hit lagging, we don't really know, but utilities are already picking up again, and just like on the equal weight part, you can see that healthcare is going in the right direction, traveling in that northeast heading. So the message here remains for the defensive sectors to be a favorite of investors, a safe haven. People tend to move to these defensive sectors when the market is in trouble, and that situation doesn't seem to have changed and doesn't seem to be changing at the moment. So the story for defensive sectors leading is still remaining. If we switch then finally to the what is called the sensitive sectors, then we see the energy sector as an outlier on the right hand side in all 3 segments: large cap, equal weight, small cap. And even here it looks as if we're going through some sort of a rotation lower, but there is plenty of room for the energy sector to correct a little bit without hurting that relative uptrend. What we also see in all 3 is that technology is clearly now pushing further into the lagging quadrant. Obviously that's a very big sector, so that's a big message here. That technology is now in a relative downtrend versus every imaginable metric, whether that's large cap S&P, whether that's equal weight, or whether that's small cap. You see a similar story for communication services. Way on the left, equal weight is already rolling over, and you see it here. This doesn't have communication services. It's inside technology, so that's going in there. And you see the improvement that we spotted in the industrial sector earlier on. That's coming back especially in large cap where it's already crossing over into leading. You see here the tail curling back up to that northeastern direction, and in the equal weight version, it needs a little bit more work. So wrapping it up, the strength of defense remains, the split universe in offensive remains, and the sensitive is a very clear winner for energy and a very clear loser for technology. Combine that with the price chart of the S&P as we analyzed it in a downtrend on the daily chart, and working very hard to get there on a weekly chart. And I think that we're still in a phase where stocks are a very dangerous asset class. You need to be very, very careful. And bonds are outperforming, but they're also dropping in price. I can't make it any prettier than it is right now. And that wraps up Sector Spotlight for this week. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please feel free to reach out on any of the channels on the screen, and obviously likes and comments are appreciated. And I hope to see you again next week at a new episode of Sector Spotlight. Same time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.